All right, good morning, everybody. Getting a little bit of a rebound this morning. The question is going to be if it's a dead cat bounce or not. Typical results after breaking like this is a 5 to 7% pullback if this is a dead cat bounce. If we're going to go to the downside, 75% of the time is the number kind of want to attach to this pullback on whether or not it's going to be a dead cat bounce and whether or not we're going to go to the downside. So 75% chance that it is, and then that we'll go to the downside 5 to 7%. Still doesn't mean we're going to crash and burn, right? It's we had a number of those pullbacks last year. Germany up the most, a little bit of a surprise. Small caps right behind that. S&P, NASDAQ. We look all the way out. We got Japan down the most, 2.5%. And I would argue that's still the country to keep your eye on. They were making waves last week. Want to see if they're going to follow through with any of that this week. Today we've got auctions in the front end, 3, 6, and then the 2-year. You could use the IRX. I suppose that'd kind of be around that 3, 6. Actually, a little in front, probably. And then we've got the president speaking this afternoon. He's been scheduled to speak before this year, and then, things happen. He doesn't show up. So just be prepared for that. He may not show up when it says, or, maybe late, maybe doesn't show up at all. It happens. We do have, obviously, NVIDIA this week with earnings. Apple's got an event this week. It's not really big. It's just a shareholder meeting. Not really expecting much out of that, except that they just announced they're going to spend a bunch of money in the US. I don't know. Every time I see a company announce that they're about to spend a boatload of money anywhere doing anything, you got to think about how it's going to affect everything. They're already spending like crazy. Now they got to add this spending on top of the spending that they were already allocating to things like AI, data centers. So it might get a short-term bump to the upside, but the bigger question is how are shareholders going to consider this? We'll see, I guess. So Apple with the shareholder event, Amazon's got an event this week too. It could lead to some new product announcements, perhaps. I'd be interested to hear what if they got anything new with delivery products, but we do have that. There was something wrong with the place where I get the GEX flip levels for SPY and the SPX. The site's not down, just that particular tool is down. So once they get it up and running, I'll share that. Not sure what's up with it. And then Spot Gamma's founder's note, we don't have the AM edition yet. Actually, I just looked. They just came out with it, but I haven't had a chance to read it, so I'll get it shared. You can kind of go through it right, so on the ES, we didn't get new highs, right? If you only trade the futures and you're not looking around at everything else, as far as you're concerned, we didn't make new highs. We just had this big sell-off. But if you look at something like the SPY, last week we made new highs, right? So that's why there's a discussion about this pullback, and it changes that right there. That new high changes what this pullback looks like when we do background and research into a pullback. So that has to be taken into consideration, and that's where the statistics come in, right? So it's not just a pullback. It's a pullback that has some numbers behind it. A typical pullback is 5 to 7%. Things stop being typical once it gets, past 7 something. And if we get below 10 or 11, then it starts the qualifications or the classification of a bear market. Now, it's not just how far did we pull back, because you can get a flash crash or some event that can knock us down 8 to 12%, and then we can still come right back out of it again. But it would start the process if we start getting below a 10, 11% and continue to the downside. There'll be a lot of talk about bear markets, and of course, whether or not the Fed could come in and try to save the market, activate the plunge protection team, blah, blah, blah. We're nowhere near that at this point. A little bit of a pop to the upside, which hasn't yet been classified as a dead cat bounce or not. We are in negative gamma. We got the volatility trigger overhead. We got to get through both of those, the 10-day, the 20-day, both overhead. We got the 10-week underneath this. We hit it in the Globex last night, opened above it, or opened on it, I should say. Stayed above it, bounced off of it. So we're doing all the right things. It's looking pretty normal at this point. We had overnight participation with 100,000. That's a pretty good number. Certainly they're not sitting out. They're not hedging. They're not backing away from it. Put wall 59.24. Call wall 62.25. I'm just going to strip all this stuff off there for a moment. Take all of yesterday. Mark the half back, 60.83. It's a dead cat bounce. If we reject off of this yellow line and continue to the downside, or if we can't even get to this yellow line. It's a pretty simple line in the sand, right? If we can get above this and get back to first just inside of Thursday's range, we've got a chance that we don't continue to sell off if we can get back in this box. The first bit would be to, one, get in there, two, stay in it, and then work our way up, try to break through Friday's high and then Thursday's high, continue to the upside. You can see when we broke down Friday, we buzz beat off the bottom of Thursday. The concept I came up with, just a word to name that behavior right there, right? It can happen to the upside, to the downside. Generally speaking, if we break down out of a range, a lot of times price wants to come back and validate old support as new resistance, or if we had broke out above, then validate old resistance as new support. So a really nice setup, right? So we've got a lot of liquidity at this level, this 6,100. We've got old trades that happened. So, that's the past, that's the trash, some footprints that were left behind. And then we've got an expectation that if we do get back up into that level, that there's going to be active trading at that 6,100. Should already expect that anyways. It's a big round number. But now we've left footprints there too, right? We've got old data and the expectation of new data at that spot. So if we can get through 6083, we still got 6092 cog line, then the round number 6100, and then a cog line at 6111. So far, we haven't even made it back to the half. ADR to the upside inside of Friday's range underneath that halfback. So we can hit the upper red line and still not even make it to that line in the sand that we need. A market's average move is to stay within these two red lines. So we would need, a little bit above the average just to get back to that halfback. All right, we're underneath the floor pivot for the week, 60.73, which means that halfback that we need to hit is above that level too. We got to get back above the floor pivot of the week before we can challenge that halfback. We got our own daily floor pivot, 60, 65 area. So far, we've hit it. We haven't been able to get through it. So it's not an MDP since we've already hit it. It's not a missed daily pivot. It's below Friday's pivot. That's bearish. We opened underneath it. That's also bearish. And it opened, or it presents this week underneath the weekly floor pivot. And that's bearish. It's not much of a surprise, right? I mean, we had a pretty good size sell-off Friday. It's, pretty obvious that we're going to have a lot of bearish signals this morning. I just shared in the chat the AM edition of Spot Gamma, so you guys get a chance to read it. Today's channel is really wide, which implies that if we break out, the breakout likely doesn't stick. If you think about it, that has some non-bearish bias to it. I don't want to say bullish because it wouldn't be bullish, but it's kind of a non-bearish bias. The wide channel implies that if we break out, it doesn't stick. So say we come down and we break out below yesterday's low and it doesn't stick, that means we come back in again. So that'd be why I'd say it's not bearish. I wouldn't really put bullish on there, at least not just from that wide channel, because we would have to run it all the way up to Friday's high and then break out of Friday's high and then fail and then come back in again. We already talked about all the things that are overhead right now that it likely stops us from even getting to the halfback, let alone getting through that half and back up to Friday's levels. The founder's note says that we're in a negative spot gamma index. I don't know, maybe they could use gamma a few more times. It's minus 2.25. It only goes to minus 4. So we're more than halfway through the negative space. If that's the range, right, then being at a minus 2, we're halfway through as bad as it could be. So when we're in a negative gamma environment, it gives us some clues about what to expect from dealer and dealer hedging dynamics. Their entire focus is to shed risk, right? The analogy would be like, spraying a duck with water. Water just rolls right off the duck. So the duck can, shed that water really easy. The market makers are trying to shed risk constantly. In a negative gamma environment, if we break out to the downside, they will sell into that selling. It makes the fall worse. It makes the fall faster. And it just increases the selling that we already have going on. If we break out to the upside, they will buy into the buying. They'll fuel the move higher. That's why we get some of the biggest moves we've ever seen in the history of the market happen in bearish market conditions. Because generally, in a positive gamma environment, if we break out to the upside, they're selling into that breakout. And if we break down to the downside, they're buying into that. So it stops the market from making big moves in a positive gamma environment, but we're in a negative gamma environment. We got a big options level at 660.50, and the first week of February, we got a point of control at 60.50, but that's all we got. Below that, we've got 6,000, then 59.50. $61.32 cog line, that's where the point of control is on the 10-day 30-minute. It's likely we don't see this change anytime soon. And we're really close to the 10-day low. 60.11 cog line, kind of the lower end of this. So we're not expecting this to move anytime soon. The only place that even remotely offers an opportunity that we could see it move to in a short period of time, say the next 2 or 3 days, would be this 60.85, 60.90 area. But we would need to get back up there first. So this implies we get through the halfback and we kind of hold above it or hold around it so that we can build out some volume at this level and bring the point of control down. We have a new VPOC from Friday. 60-32 cog line. That profile is not a perfect profile, but it looks very, very good. This is the only area where it kind of messes it up, but that is a lowercase b profile. You can see where they came in and really tried to save things Friday afternoon. If we come back to this level and they're not there to defend it, I think it'll get really violent really fast in the short term. So we want to see them double down if we do go back to this spot. We don't need to consider it as support or resistance. That puts bias in it. But we can just look at the facts and say there was a lot of trading activity at that spot on Friday. And if we go back there again today, there's likely going to be trader's remorse or unfinished business, a lot of trading at that level. At the bare minimum, we can expect that. That keeps our bias out of it from considering whether or not it's bullish, bearish, supportive. New week, new range. When we looked at this range on Friday, it wasn't set in stone yet. It was still alive, still moving. Now it's locked. It won't move anymore. And while we can compare it to last week, it's not really a fair representation because this week that we're in now is a 5-day week. Last week was a 4-day week. So sure, this week's range is bigger. It's got more days, so it should be bigger. One thing that we can do is compare it to the week before last, because that was also a 5-day week. And if we do that, we can see that this week is just a little bit bigger than the last 5-day week we had. There's some volatility being priced into the market for this week, which at first glance is kind of a catch-22. If there's a really big event on the horizon, like an FOMC, it's volatility suppressing. The markets will expect a few days of sideways before that event gets here. And so we end up with a narrower week because of that impending sideways behavior before a big event. So if we're seeing it wider, it means they're pricing in the volatility as if they're expecting this week to have some movement, not from an event. Or it implies that we're not going to sit sideways waiting on an event. So keep your eye on the VVIX, the volatility of the VIX index. If that confuses you, think about the idea that you can bring up, Apple, SPY, Microsoft, Amazon, the ES, the NASDAQ, and you can always look at a volatility tool when you do that, right? There's an implied volatility indicator, and you can apply that to anything that you're looking at, right? And this gives you an idea of what the volatility is on whatever product you happen to be looking at. Pretty simple, right? You follow that logic. Well, what happens if you look at the VIX? You don't want to look at the implied volatility indicator on the implied volatility of the market. How do you gauge the volatility in the volatility? Sounds kind of silly, right? That's why we look at the VVIX. This is the volatility of the volatility index. So how volatile is the volatility? Keep your eye on that. You can also look up skew. I know you've probably heard people talk about skew, the skew within the options of whatever product it is you're trading, but there's an actual skew chart too. The buying has been strong and steady over the last few weeks. Even with all this violence, it's still been constantly bought up. Lots of continuous buying. No fear. No fear. It just continues to be bought up. The thing is, at some point, it'll just flip like a switch, and out of the blue, the market will be in a different headspace. So you just want to keep your eye on it to make sure it hasn't suddenly flipped. Looking at things over a 5-day period, we've got a mixed bag. These top three are the risk on sectors. If we're going to, hold the line and go higher in the markets, we need those three. Now they're broad and vague. Tech, that's really broad, it's really vague. Consumer discretionary and financials, but those three carry the market. So we need those to quit falling, to stabilize, and then to slowly begin working to the upside. The defensive names like staples, healthcare, utilities, they've been doing really good over the last 5 days. And then, of course, the midline, building materials, industrials, energy, it's a mixed bag. But these bottom ones, whether you're looking at this from a growth versus value or, just more of a risk versus defense, these are defensive sectors down here. It's where we expect people to go when their forward outlook is uncertain. Safe haven assets is another way to look at it. So no Bitcoin, no, way overpriced, expensive tech companies, the boring, slow, sleepy, low beta movers. The China group is down this morning 2%. They're still up almost 3% over a 5-day period. And looking at things that are up this morning, chips, semiconductors, Bitcoin, gold miners, precious metals, uranium, financials. That's a good start. But we need things like cloud computing. We need the Mag 7 collectively. So it's a good start. Now, we've seen markets go sideways in front of NVIDIA's earnings before. I don't think we're necessarily going to see that this week. It's possible, but I think we're past that point. So if we do go sideways, it'd be the hurry up and wait that we've talked about before. Looking at that weekly expected move, they're pricing in moves this week like they don't expect us to go sideways and wait. The thing is, if everything is trapped inside of this really big bar, I mean, yeah, we're looking at the ES, but we can jump around and look at a lot of markets. If they all have this big bar, Apple, Amazon, Microsoft, Tesla, Google, go down the list. If everything you look at has this big bar, then everything has to get through the halfback of that bar. So, you can find a lot of bullish stuff or things that are up this morning, but keep your eye on that midpoint because that's what we have to get through. So we can see markets rally in front of the NVIDIA earnings just to try to get back to where we were. that wouldn't mean that they were waiting on earnings as much as they were just trying to get back to where we were before that drop last week. We don't have the market leadership this morning, right? We don't have the tech, the Mag 7, the chips, communications. You don't have the risk. We've got agriculture and precious metals and uranium. Now, don't get me wrong, Bitcoin's in there. And it's green, up more than 0.5%. But, you know, if we look at that big bar, it didn't make it through the half, and it's pointing to the downside. All right, we still got the 10-year below 4.5 and the dollar below 107. So at least with this big drop we had on Friday, we didn't see a significant rally in the 10-year and the dollar. I'll take it. If we got to look, you know, for the silver lining, there's that. So, you know, on the one hand, I kept saying if we couldn't get this done, they would wash it. Well, that's the start of a really good wash. These previous pullbacks, I think this one was 9 plus. This was like a 5. That wasn't even a 6. I think this was a 5. So this is just one pullback, right? One day, 1 week, I should say. We've been topping out, holding this high, trying to digest up here so that we can finally move on. And if they are not able to get it done, they will wash it and start over. So you got the December 18 candle. That was FOMC December 18. Everything that we're doing is still wrapped up inside of that week. Get out of that box. The halfback is 60.14. If we break that, we can test the low again. That's 58.66. Keep your eye on the clock. Look for anything that says the president has canceled his speech this afternoon. I don't expect him to cancel. Honestly, even if he doesn't show, I don't expect them to say he won't show. They'll just leave everybody hanging like they did last time. But you know, just be prepared for the idea he doesn't show. And then if he does, well, great. Keep your eye on the clock. We got auctions. I'll see y'all tomorrow.